Here's a quick tutorial of the 3 most common depreciation methods. If you're interested in information about depreciation in general, check out my Depreciation Explained video. When an organization first buys an asset, the question is this asset something to be capitalized or expensed? The objective of this video is to talk about depreciation, so we're obviously going to capitalize it. But you want to pay attention to everything that you're putting into it because some of those items may need to be expensed. But in general, to capitalize something is the total of all the costs that you have to pay in order to get it ready for its intended use. So if you're buying a school bus and you have to pay for the title and you might have to pay for someone to have an inspection, those inspection before you buy, those kind of items are necessary items to get it ready to use, so we're going to capitalize them. When you buy it and you've got to pay for gas and maintenance, those items are expensed, and we're not going to deal with them in this video. Here's some quick facts about our school bus example. This bus is going to cost $110,000, last 5 years, and the school's going to buy it with cash. Although the depreciation does not matter if it's paid for in cash or with the loan. Just, I want to get that out of the way. We're not dealing with any cash here. We also know that the value of a bus or any vehicle goes down immediately after it's purchased, and the value goes down each year as the bus or any other asset has wear and tear on it. So we kind of know that going into it, and there's an estimated salvage value of $10,000. That might not be the end amount, but that's a good faith estimate, and so we're going to base all our calculations on that salvage value of $10,000. If we buy it for $110,000 and we're going to end up with $10,000, we're going to use $100,000 worth of that value. So therefore, that's the amount we're going to depreciate, and we call it depreciable base. The formula is simply the cost less the salvage value, and that gets you to your depreciable base. For our example, we buy the bus at $110,000, have a $10,000 salvage value, that leaves us with a $100,000 depreciable base. The first formula for depreciation we're going to discuss is straight line. The idea behind straight line is that if we were going to make a graph and our depreciation expense was on the y-axis and our life is here, the depreciation amount is going to be the same each year, or it's going to be a straight line. The way to make that happen is to take your depreciable base and divide it by the life. And that way you're going to have the amount equal each year, or straight line. For our purposes, it's the $100,000 depreciable base over a 5-year life, and that leaves us with $20,000 per year. So we are going to depreciate the school bus at $20,000 per year when we use the straight line formula. So just like the straight line on the graph, each year's depreciation is going to be the same at $20,000. This is just visually another way to look at it. So looking at this table, I like to set it up in Excel because it lets me know where I've got my columns. It helps me make sure I've got everything calculated properly. So it's easy enough to do. I always make a track of what the years are. Year 1, 2, 3, 4, 5, no big deal. I also keep a list of the assets cost. This is because the $110,000 is the amount on my balance sheet. Even though the depreciable base is $100,000, I need to keep my cost at $110,000. That is exactly what the historic cost principle tells me I must do. The next columns kind of depend on what your preference is for the order. I like to link the asset and accumulated depreciation together because when I take the asset minus the accumulated depreciation, That gets me to the net book value. So you can easily see this, but before we get to the accumulated depreciation, we have to calculate the depreciation expense. We've calculated that, and that amount is $20,000 per year. We've just done the straight line method. So while we know depreciation expense is $20,000 per year, the accumulated depreciation is going to change. In the first year, there was no prior year, so accumulated depreciation is simply the depreciation expense for this year. In the second year, accumulated depreciation was our beginning accumulated depreciation plus the additional $20,000 in depreciation expense for this year. Same for the third year. We begin with an accumulated depreciation of $40,000 and we add this year's depreciation of $20,000. The same thing goes on for the fourth year, and in the fifth year we've got the prior year accumulated depreciation of $80,000 and this year's $20,000. So we've accounted for it. This amount, accumulated depreciation at the end, is going to be equal to my depreciable base. The other thing to note about this table is your net book value decreases each year. When your net book value has reached the salvage value, you should be the end of your life. That tells you you've done things correctly. So this is a nice table for understanding straight line depreciation. If you understand this table, you want to make similar ones for the other depreciation methods because they help keep you organized. The entry is easy. We debit depreciation expense and credit accumulated depreciation. But you need to pay attention to your organization because they may have accumulated depreciation equipment, accumulated depreciation vehicles. There can be another category because you need to remember accumulated depreciation is a contra asset and it offsets the related asset. But depreciation expense, that could also have depreciation expense vehicles, depreciation expense equipment, etc. But it's still the expense that's going to go on your income statement. The next easiest method to understand is units of activity. Sometimes our asset doesn't wear and tear equally over time. It wears and tears as the asset's being used for production. So for our purposes, we're going to say, well, what if that school bus is going to last us for 200,000 miles? We kind of approximated out ahead of time what we're going to do for depreciate or how many miles. But the reality is you estimate ahead of time you're going to have 200,000 miles. And then each year you keep track of it and you depreciate for those first 200,000. But we're looking at this in hindsight, and so we're saying year one we drove 45,000 miles, year two 55,000, etc. By the time you finish year five, you can find out that we've driven the 200,000 miles that we estimated would be the life of our school bus. We don't need to go ahead and recalculate the depreciable base of $100,000. We know how it's calculated. We're just going to use it again. We've got the $100,000 depreciable base over 200,000 miles, and our depreciation rate is going to be 50 cents a mile. If this sounds an awful lot like straight line, that's because it is. We're depreciating at 50 cents a mile. It's in terms of per mile, it's the same depreciation rate, just like straight line depreciation is the same amount per time period. The only difference is now we have to take this per mile and bring it out. How many miles were used this year? To do that, we come back to our table. The addition to our table here is of the activity column. That's just there to keep you straight. It could be elsewhere on your spreadsheet. I just like everything in the same place. But we still have the cost, less the accumulated depreciation, in order to arrive at our net book value. We just have to calculate depreciation expense. And what we've done is if we know that the activity rate is 50 cents a mile, then our depreciation expense is 45,000 miles for the first year times 50 cents per mile. The same thing with the second rate. The second year, rather, it is 55,000 miles times 50 cents a mile. So our depreciation expense is simply the activity amount, so if you're doing it in Excel, it's just going to be that cell times 50 cents, because that is our rate. Everything else stays the same in terms of what you're dealing with. Our net book value is the cost minus accumulated depreciation. So we know we're going to see our net book value decrease. We also know that at the end of the asset's life, the total accumulated depreciation is equal to the depreciable base, and the total net book value is equal to our salvage value. If you look at your units of activity depreciation, you can see that the amount actually varies each year. That's because the school bus was driven different miles each year. So it makes sense. Some years depreciation is more, some years depreciation is less. It really doesn't matter what the time is. Depreciation is computed based on how many miles have been driven. But the journal entry is the same. Debit to depreciation expense and a credit to the accumulated depreciation. So you're booking the asset, which is going to go on the income statement, and you're also showing the wear and tear by crediting the contra asset of accumulated depreciation. So we've covered the first two methods, and they're straight line, or the equal in terms of the formula. It's the depreciable base divided by the life. Units of activity, we have to take it one step further and multiply it by how many activities were done in that life. But you could argue that's the same thing with straight line. It's depreciable base divided by the life times the number of years, when we just seem to be using one. So it kind of can calculate that as the same formula. But now we're hitting something different, and there's a couple things you need to remember. This is accelerated depreciation, and this says that your asset wears out more the first year than the second year, and the second year the amount it wears out is worth more than the third year. And if you think about a car you buy, as soon as you take it off the lot, the price drops. Well, it's the same kind of concept. Once you get things going, the wear and tear kind of slows down. The first method we're going to talk about is double declining balance. There's also a method called 150% declining balance. It's very similar to the makers, which is used for your taxes, but we're not going to deal with it. If you have to, instead of for double declining balance, which is 200%, you would sub it out 150%. But otherwise, everything else is the same. The real trick to understanding accelerated depreciation is that each year your depreciation is a percentage of the net book value. When we calculated depreciation for straight line and units of activity, we used the depreciable base. We're still going to get to where our total accumulated depreciation is equal to the depreciable base, but we don't touch it for computational purposes. Students tend to make that as the most common mistake. The second most common mistake is that they take it as a percentage of the cost of the asset. And that's not it either. It's the cost less accumulated depreciation, or the net book value. That's what's important when calculating accelerated depreciation methods. The other thing that kind of doesn't make sense to a lot of people, but it does when you really think about it, is if you're taking a percentage, you never ever end. It keeps going. So you have to plug at the end. And most of us realize that there gets to be a point where it makes no sense to keep calculating fractions of a penny. So think about it. How much did you pay for dinner last week? Now take 80% of that, and 80% of that, and 80% of that. You're eventually down to less than a penny, but you could keep going out to many, many decimals. So at some point you have to stop. We're going to plug it at the end. We know that our salvage value is going to be our net book value. So that's when we're going to stop depreciation. And we're just going to force depreciation or plug that last year. The formula takes a couple different steps. You could do it all at once, but it just makes sense to break it down. First, you're going to compute your life as a percentage. Second, we're going to take, if it's double declining balance, it's 200% times that life. And we're going to multiply it by the net book value. And the third is you stop when net book value is equal salvage value. Let me explain a little more. compute your life as a percentage. When we did straight line, we took 1/5 of the depreciable base each year. You could also say we took 20% of the depreciable base each year. So if it's a 5-year life, 1 divided by 5 is 20% each year. Second, we're going to take 200% of that. So we're going to take 20% each year times 200%, multiply that by the net book value, and that's each year's depreciation. So we end up with 40% times net book value as each year's depreciation. And the third step is to stop depreciating when the net book value reaches $10,000, because that's when we will have depreciated our entire value of use. Now this computational table is similar to the one we had before. Instead of having the units of activity column, I've got a net book value before. So I have a net book value before depreciation and one after depreciation, just to help keep all of my records straight. The idea is your net book value before, you're going to multiply that by our rate of 40%, and that becomes our depreciation expense. So we start with the net book value before we took any depreciation, equal to our cost of 110 times 40%, we end up with depreciation of $44,000. That gives us a net book value at the end of the first year of $66,000. And the net book value at the end of the first year is also the beginning book value at the end, or beginning book value for the second year of $66,000. 40% of that is $26,400, gives us accumulated depreciation of $70,400, and a net book value afterwards of $39,600. So the net book value at the end of year 2 becomes the net book value at the beginning of year 3. This again becomes 40%, so depreciation is $15,840. Accumulated depreciation becomes $86,240, and net book value afterwards of $23,760. Net book value at the end of year 3 becomes the beginning book value, net book value at the beginning of year 4. When you're dealing with double declining balance, you really need to start paying attention to the ending net book value, because this is where you might have to make some adjustments. You might have to make adjustments in year 4, even though the life is 5 years. So if the salvage value was $15,000, we would have a problem at the end of year 4. But we don't, so I'll explain a little bit here. We start same thing, $23,760 is net book value at the beginning. 40% of that's $95,004 for depreciation expense. That gives us $95,744 as accumulated depreciation, and a net book value at the end of $14,256. That becomes our depreciation or net book value for the beginning of year 5. 40% of that is going to make our depreciation equal to $5,702 and make our net book value of $8,500. We can't have this because that would make our net book value greater than our salvage value, and we know that can't possibly occur. So we have to kind of force this year. And what we end up doing is starting it all over again with the same net book value at the beginning before depreciation. And then since we know 40% will cause too much depreciation, we kind of plug how much depreciation can we take and still make sure that at the end of the asset's life, our net book value is equal to the salvage value, and that the total accumulated depreciation is equal to the depreciable base. So how we do that is simply taking our beginning net book value of $14,256, subtracting out the net book value that we want at the end of $10,000, that gives us depreciation of $42.56. So whenever you're dealing with double declining balance, you kind of have to force it. If your salvage value is really small, you might go into a 6th year. If your salvage value is very large, you might have to do this the 4th year. But you need to pay attention to it, and you need to stop depreciation when your net book value is equal to the salvage value. And if you look at depreciation over time, depreciation decreases each year. The first year's $44,000, and by the fifth year, it's only $4,000. So we have accelerated the depreciation, or pushed most of the depreciation to the beginning years, because we're arguing there's more wear and tear on the asset and more of that decline in value in that first year than there is in later years. But while we're taking an accelerated method, the entry does not change, still debit depreciation expense and credit accumulated depreciation. And here's a total of different things for each of the methods we talked about. No matter what, the straight line method, the units of activity or double declining balance, salvage value is equal to net book value in all cases. The total accumulated depreciation when you're finished is equal to the depreciable base. Those are the things that are the same. The difference is in how we calculate the depreciation. The first two, straight line and units of activity, it's a base divided by life. But don't forget the units of activity you have to multiply by that activity. And double declining balance. It's got similar things in there. Students always get confused because we use life as part of the formula, but it's double 1 divided by the life. And don't forget, you always multiply it by net book value, not by the depreciable base. And the concept of straight line is depreciation is the same each year. The concept with units of activity is depreciation is the same per unit, but depreciation varies with activity. And in double declining balance, it's going to decrease each year, and you need to make sure you end it by yourself. So I hope this helps your understanding of depreciation methods.